if you're an income investor, you've probably seen a number floating around that seems, well, almost too good to be true. Today, we're unpacking the massive yield on the ProShares Bitcoin Strategy ETF, BITO, to figure out what is really going on under the hood. So let's dive in. And there it is, a yield somewhere in the neighborhood of 50, even 60%. I mean, wow. This is the number that's been grabbing all the headlines and really turning the heads of investors who are looking for cash flow. It's an absolutely enormous figure, but to really understand it, we need to know exactly what it represents. So that 57% has a very specific name. It's the trailing 12-month distribution yield. Now, put simply, all that means is it's the total cash that was paid out over the last year divided by the fund's recent share price. The key word here, you guys, is trailing. It is a look in the rearview mirror. It reflects a very specific and volatile period of past performance. And that brings us to the million-dollar question, doesn't it? Is this what we typically think of as income? Is it like a steady dividend from a blue-chip stock or the interest you get from a bond? Well, the answer is not really, and understanding that difference is absolutely crucial. So if it's not a traditional dividend, where does the money for these huge payouts actually come from? To find out, we have to pop the hood, deconstruct the BTO machine, and see exactly how it works. Okay, let's start with the absolute basics of BITO. It was the very first US ETF linked to Bitcoin. But, and this is a critical point, it doesn't hold any actual Bitcoin, not a single one. Instead, it tracks the price using futures contracts. And to do this, it operates through a subsidiary down in the Cayman Islands. Believe it or not, these structural details are the very reason this massive yield even exists. And here's where the contrast is just everything. A traditional dividend, right, that's a slice of a company's actual profits, it tends to be pretty stable. BITO's distribution, on the other hand, is a totally different beast. It's a payout of realized gains from trading futures plus a little T-bill interest. That makes it incredibly volatile. And as we're about to see, it's taxed very, very differently. Now, this is a key mechanic you have to get. When BTO pays you a distribution, it's not creating new wealth out of thin air. The fund's net asset value, its NAV, drops by the exact amount of the payout. You're basically just taking money from your left pocket and putting it in your right. You're converting a piece of your investment's value into cash. All right, now for the part that really catches a lot of investors by surprise, the tax implications. If you only focus on that big, juicy yields number, you could be missing a huge and potentially costly piece of the puzzle. So let's follow the money on its little journey, okay? Step 1, the Cayman subsidiary makes money trading futures. Step 2, that profit flows to the main BITO fund as income. Then, the fund pays it out to you. At the end of the year, you get a simple Form 1099. But here is the kicker. That income is generally taxed at your higher ordinary income tax rate, not that nice lower qualified dividend rate. Ouch. To really put that in perspective, just look at the difference. As a BITO shareholder, you get simplicity, just a basic Form 1099, but you're staring down a potentially much bigger tax bill. Someone who trades futures directly? Yeah, they have more paperwork, but they get a much more favorable tax treatment. It's that classic trade-off, convenience versus tax efficiency. So this brings up a really crucial question. Where should you even hold an investment like this? Well, because the distributions are taxed as ordinary income, holding BITO inside a tax-advantaged account like an IRA or a 401k can be a much, much cleaner and more efficient way to avoid that annual tax drag. Okay, so we get how BITO works now, but how does it really stack up against all the other ways you can get crypto exposure? It really comes down to finding the right tool for the job you're trying to do in your portfolio. See, every one of these strategies comes with a very distinct trade-off. With BITO, you get that high potential yield, but it's a wild ride and it's tax inefficient. The new spot Bitcoin ETFs, they're much simpler, they track the price directly, but they offer zero distributions. And then you've got covered call ETFs, which can generate some income, but they might cap your upside if we get a big bull market. So with all this information, how should a practical, savvy investor think about actually using BITO? Let's turn all this knowledge into an actionable playbook. All right, here's your checklist. First, think of BITO as a source of volatility in your portfolio, not a stable bond. Expect the payouts to swing wildly. You're going to see some huge months and you're going to see months with nothing at all. Know the ordinary income tax treatment and seriously consider putting it in an IRA. And maybe most importantly, Do not chase the yield by buying right before a payout. Focus on your total return after taxes. Okay, one last technical piece that is so crucial to understanding the engine here. It's called roll yield. When the futures market is in what's called contango, the fund faces a headwind as it has to roll its contracts. But when it's in backwardation, it gets a nice tailwind. This market condition directly impacts BITO's profitability and therefore its ability to make those big distributions. You know, the absolute best way to think of BITO's yield is like a steam gauge on an old locomotive, not a contractual payment. It simply shows you how much pressure, in this case realized gains, has built up in the system recently. It is not a promise of what's coming down the tracks. So here it is, the bottom line. That massive, eye-popping yield isn't some magical income stream. It's a direct feature of BITO's unique, futures-based structure. It's a reflection of a past period of high volatility and realized gains. It is not a promise of what you'll receive tomorrow. So I'll leave you with a final thought to chew on. Knowing now that a spectacular yield can simply be a byproduct of past volatility, how does that change the way you search for income in your own portfolio? It's a really crucial question for every single investor out there. Thanks for joining me.